This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Today on the podcast, I have Mebane Faber. I believe it's his third time. I hope I'm right about that. Memory's tough here. And look, let's face it, it's a lot of work for me to go to my own iTunes listing and try and figure out how many times a guest has appeared. Oh no, I guess I should. But I'm not going to. Mebane is an all-around okay guy. He's a market pro. He's involved in a lot of different areas of the markets. He has great insights, very practical, very pragmatic. No BS. I like that. His book, very well known for, The Ivy Portfolio. His blog, well read, thought leader. Check him out on Twitter. Lots of insights, great conversation. I hope you enjoy. So what do you think? You're a pretty discriminating guy. Is the podcast still going a slightly coherent direction, or is it falling off the rails?
I love it as a new medium. You know, for me, I listen to podcasts in general as when I'm traveling or maybe at the gym. The challenge, of course, is, it's a lot of material to listen to podcasts, and each one you're looking at a chunk of a lot of them are an hour or 30 minutes. I think yours have been a little shorter lately, but it's good. But it's the same problem for me that I have with other forms of media, which is, how do you find the true gems out of the flood of information, right?
Yeah.
I don't have a good solution for that, really. I need an assistant to wade through the amount of stuff out there. But yours, not just to compliment you, but yours is one of the most professionally done. I've subjected my girlfriend to listening to quite a few of them when I'm cooking or doing something, and usually a lot of them she's like, this is terrible. This person is awful at interviewing or the quality of it or whatnot. But she gives you gold star. She gave Ritholtz a gold star. I mean, granted, his is put on by Bloomberg Radio, so not surprising. But some of them, it's a craft and also the technology side of it. So you do a good job, especially as an interviewer. But, hey, you've done 300 of these, so I hope so.
I will send you your check as appreciated.
Good.
Hey, so listen, let's jump in and discuss some things. Going through your blog, kind of prepping to talk with you, I noticed a comment that you had that emotions are just as difficult for trend following as buy and hold, just different times for different reasons. Why don't I let you explain that before I try and hit you over the head with it?
Yeah, anytime you put money to work, hard-earned money that you've spent hours and weeks and just time spent earning it, investing, you're going to have an emotional attachment to it. And also with spending it as well. And so when you're investing, it doesn't matter if it's in municipal bonds or in foreign stocks or an active trading approach, none of those investments or even investing in a house, right? Being at risk, none of those investments are guaranteed. And so a buy and hold investment approach, and we've done an enormous amount of modeling on this and have a new book coming out on that, hopefully this month. It's supposed to be last month, but hopefully soon. Has its benefits and drawbacks. And the long time horizon is usually great for a lot of these investments to work out, but the key word being drawdowns. Volatility is one measure, but drawdowns in general. And so investing in the broad markets as a buy and hold investor, you really don't have much control in the process, right? You're buying, and really that theory is that's it. You hold and you rebalance, but it's a very difficult psychology for someone to watch as they lose a lot of money. A perfect example right now is if you are a buy and hold investor in energy or oil or precious metals, or foreign stocks, you are every day waking up to a lot of these investments going down 1%, 2%, 3%. And so that's emotionally very difficult. Well, trend following is simply, as you know, an active approach to investing. And so you have the same problems of losing money, but it's often at different times for different reasons. It's more the whipsaws. And the example I gave was energy over the past 3 or 4 years. You had this back and forth with oil really since the action of 2009, where a trend follower probably was getting a lot of small cuts. And maybe after the 9th losing trade in a row, the last thing you want to do is pull up your screen of oil to see it sitting at 100 again and exiting or getting long. But then you have what happened, over the past 3-4 months, which is, makes it all worthwhile, of course. So it's a different sort of pain, but the same pain. And we actually did another study that looked at, there's only 2 states for an investor, right? It's either, by definition, it's either you're at an all-time high or you're in a drawdown. And there's no other place you can be. And the reality for most buy and hold asset classes, you're only at an all-time high about 1/5 of the time. And so the rest of the time you're spent in some form of drawdown, which is, considerably difficult to send through from a mental perspective. So no matter what, the takeaway is that the challenges of investing are emotional and difficult, no matter how you go about it.
As I saw that comment, the one thing that I started to think of was Taleb's comment, the fragility issue, the anti-fragility issue, in the sense that, of course, emotions are going to play a role, but I guess from the ground up, one understanding their style or their strategy, because I think most people would probably typically agree, if you're just a long-only investor right now, for example, of U.S. stocks, there could be some fragile aspects to that strategy, whereas a strategy like trend following can excel when things start to hit the fan, can excel when volatility starts to go a little loose, so to speak. And so I think you're right. The emotions we're human beings. It doesn't make a difference. You're still going to have the emotional connection, the feeling. But I think when the strategies are different, the emotions might be different, or at least if your understanding of what your strategy is. Does it make sense where I'm trying to go with that?
Yeah, well, the biggest thing, and look, trend following is my desert island strategy. If I had to put money somewhere for the next 10 years, close my eyes, it would always be a trend following style of strategies, because it has the ability to react to what's happening, right? If you're in a long, pronounced deflationary environment or inflationary environment, there's certain types of asset classes that will excel in both of those, and they're not the same. And you can do some of the same things with buy and hold, trying to make it robust, but it's challenging. So the trend following, the biggest difficulty you have with the buy and hold crowd, of course, is you end up similar to the vast majority of the population. So it ends up being somewhat of a growth exposed U.S. dollar based in the U.S. home country bias sort of portfolio, but you have the emotion of being not in control, of not doing anything. And, God forbid we have another 80-90% bear market like we did in the Great Depression. That sort of devastation to a portfolio is really hard to recover from emotionally or mentally. Now, a trend following approach may work better, it may not, but a lot of people, and myself included, have a really hard time just watching it evaporate and think that that's very difficult on the psyche.
Let me jump you around. I saw a post of yours. I thought it was an interesting take and how you were putting things together. I'd love for you to explain the idea and some of your research, some of the thinking behind it. But so Ray Dalio at Bridgewater, famous of this notion of an all-weather portfolio, and he uses his risk parity strategy. And you were comparing this to what you were calling a global asset allocation, GAA. Why don't you explain a little bit about Dalio first, what risk parity is, his all-weather portfolio, how that is using his strategy of risk parity, and then what you were comparing it to. That was really interesting.
So for those listening that don't know, Ray Dalio runs the largest hedge fund in the world. I think it's in the ballpark of 160 billion in assets across strategies, consultant to a lot of the world's biggest sovereign wealth funds, pension funds and endowments. He runs two main strategies. One is called All Weather and one is called Pure Alpha. All Weather goes back to 1996, but it basically, he said, there's two types of investments. One is what we call beta, which means it's a long-only asset. So think U.S. stocks like the S&P 500 or U.S. bonds or gold. And there's relatively few of these. So these asset classes, the returns are fairly stable over time, meaning they go up and to the right over time. But it depends on various market environments. So he said, look, and his Pure Alpha is more of a traditional multi-strategy hedge fund, long, short, and is independent of market direction. But All Weather, his goal said, I want to be able to build a portfolio that if I pass or I'm not involved in my trust, that I can give to them and it can be run for the next 100 years. And what's important to me is that portfolio is exposed to perform in any market environment, whether it's deflation, inflation, growth, or recession. And the biggest challenge he saw with portfolios, and this actually goes back to the 1950s with Markowitz, is that most investors, let's look at the traditional 60-40 portfolio, which is really the benchmark for most institutions, 60% in stocks, 40% in bonds. And his insight is that, hey, look, having 60% in stocks is really not, it's $1 60%, but for volatility, because the stocks are much more volatile, you actually have more like 90% exposure to stocks. And so it's not really a balanced portfolio. And so his insight said, look, there's no reason to accept asset classes at their current leverage level. That's just packaged the way it is. If you want bonds to return closer to stock-like levels, you can use leverage. If you want stocks to be more on the return of bonds, you can actually deleverage them and put some in cash. So then he said, once you equalize assets based on their volatility, and other people do it different ways, but we'll say volatility just to be simple, long-term stocks are 15 to 20% volatility, bonds much lower, around 10. And so he said, once you do that, you can come up with a more balanced portfolio. Now that's an insight that is a modern application, but it's something that's been around since the 50s with Markowitz, Sharpe, a lot of these guys that had published portfolio theory, but the advent of the futures markets made leverage a lot easier. And this actually, CTAs, commodity trading advisors, have been doing volatility-based portfolios since the 70s, right? So this is nothing new. It's a little bit of marketing, but what he's done, he's done a good job of, is putting together a portfolio, and they call this risk parity now. A different group kind of named that, and there's dozens of guys that do this, mutual funds and huge endowments, but it basically has the effect of adding more in bonds, but it also adds commodities and other asset classes. So I love the theory in general, and usually to target similar returns as 60-40, you end up leveraging this risk parity portfolio maybe by a third. So it's nothing crazy, but it does have leverage. But the challenge, of course, is, does that sort of portfolio make sense now after you've had a 30-year bull market in bonds? And that's a little more challenging to answer, is because you've had this huge tailwind of yields going from double digits down to 2% or less in some countries. Will that be repeated in the next 30 years? Well, that's highly unlikely.
Unlike my world and some of the things that I write about that are a little more agnostic to where things might go, it just kind of follows along. He is setting forward a vision of how the machine works and how it will continue to work, and it might not.
Well, here's the interesting thing. And so we, in this new paper or book we're putting out called Global Asset Allocation, I set out to say, look, I'm an engineer by background, a scientist. Let's look at the data. Let's take as much data as we can find, run all of these gurus that have recommended portfolios. So Dalio actually recommended a retail allocation in the recent Tony Robbins book. But there's been a lot of other guys. David Swinson runs the Yale Endowment. Rob Arnott, who runs Research Affiliates, another $100 billion plus money manager. We looked at 60/40. We looked at Harry Brown's permanent portfolio. We looked at Mark Faber, no relation, but his portfolio. And then, of course, Warren Buffett's, which was simply put 90% in stocks and 10% in bonds. And we compared all of these recommended portfolios, and a lot of them are pretty different. Some would say, I want to put 25% in gold, and another would say, we don't put anything in gold, and another would say, I want X amount in stocks. And really, really interesting insight is that, and it's kind of like baking, and I'll explain that in a second, but as long as you have some stocks, and as long as you have some bonds, and as long as you have some real assets, and those I define as commodities, gold, tips, and real estate, your asset allocation, if you're a buy and hold investor, actually doesn't matter all that much. And so we looked at about 20 of these strategies, okay? The difference between the lowest performing strategy and the best performing strategy, and this is since 1972, and we did real returns net of inflation. So inflation was maybe, I think, around 4% over that time period. The difference between the best and worst was about 1.5%. Okay, and so the real return's around 4 to 5.5%, and then nominal, of course, it's up around 9 or 10. But that insight, where if you're a buy and hold investor, the asset allocation, how much time do people spend on, how they allocate their assets? Well, I'm going to move 10% into stocks to 12%, or I'm going to sell my gold down 5%. It really doesn't matter that much. But what does matter if you're a buy and hold investor is how much you pay for that.
The fees.
The average mutual fund, 1.25%. So the top quarter is up around 2%. The average advisor is, another 1%. ETFs are down around 0.6% or less. But if you had perfect insight and said, you know what, I'm going to pick the perfect asset allocation portfolio for the next 30 years of these 20 and know that ahead of time. And in this case, I think it would have been one of the endowment style, Swinson or Arian, because they were highly exposed to growth type of assets. Paying your average advisor in mutual funds would have transformed the best performing allocation to the worst, right? So it would have taken the absolute best allocation and turned it into the worst allocation simply by paying fees. So if you're a buy and hold investor, the biggest thing you can do is not worry as much about your allocation, but rather, pay as little as possible in fees and just don't mess with it. Now, the biggest difference you saw in returns was, of course, the 70s and portfolios that had exposure to real assets did better. And that was really the kind of defining moment for a lot of those on the consistency, which was surprising to me and interesting. But in general, the biggest takeaway from this is don't spend much time on the asset allocation, but rather pay as little as possible.
Those fees, and when you start to consider compounding, just eat you alive, huh?
The example I gave, I said, look, the reason people are not fee sensitive, and this has to be true because of all the vast fees they're willing to pay on a lot of these mutual funds and active funds in general. And that doesn't mean they're not viable, right? There's plenty of active funds that all that matters is net returns, net of all fees, right? Trading commissions, taxes, everything. However, if you're doing buy and hold, by definition, you're not really doing anything, right? So, but what I tell people and what I say in the books, I say, look, envision, instead of you just getting your statement every month and the fees getting skimmed off, and skim's probably a bad word, but that's kind of what happens, right? They come out of the accounts. You never really see them. If you're $1 million client and you're paying 2% in fees a year, just imagine going to your advisor every year and taking a briefcase with $20,000 in cash every year and saying, are you worth $200,000 plus over the next 10 years? I'm basically buying you a Tesla every 2 or 3 years, new. Is that, and God forbid you have more than $1 million because it just gets more gross. But once you put it in that framework of visualizing it, it's much more difficult for people than it is if it just comes out of the account and they never see it.
But you have to frame it that way. If you don't frame it that way, it doesn't make any sense. It's like a wheelbarrow full of cash rolling into your advisor.
Yeah. Well, I just read a new book, and I'm going to blank on the title. I think it's called Happy Money, but it spends a lot of time thinking about how people spend money and the utility they get from it. And it's not nearly what they normally optimize on. People in general think about spending on things, buying stuff, but a lot of it's experiences, and they talk about ways to optimize your spending. And so stuff like, having a reoccurring fee that you never see is a lot easier to pay because it's like it evaporates into the ether. But actually going through the pain of writing a check or taking someone a wad of $20,000 every year makes you think about it a little more, and makes it a little more important than it just getting skimmed off the top.
By the way, some of these the markets, last 6 months, oil, one hell of a chart, huh? Look at copper right now. What is going on? I know you're not going to be able to predict. I know that's not your style to try and say what's going to happen tomorrow, the next week, next year, but there's a lot of indications of things, volatility returning, big moves returning. Interesting, huh?
Well, this is, as you and I, this is a fun part of the discussion. And as I always say, being a quant, none of what I'm getting ready to say will make its way into the portfolios, but I do enjoy gossiping about it, and I'm more than happy to give my input. Where we exist in a world today is difficult for the U.S. investor, difficult for the global investor, and many people refer to as financial repression, where you have inflation that is competing with bond rates. And you've seen at least decent bond rates in the U.S. relative to inflation, but struggling in many places abroad. So let's start with U.S. stocks. U.S. stocks are expensive across any measure. All right. Now, I don't think it's a bubble.
Quantitative measure, right?
Quantitative measure. So you look at, we often talk about 10-year price to earnings. It's sitting around 27. Now, for perspective, it hit 45 in the late 90s, so it's not the worst it's ever been. But future nominal returns around 3%. 4% if you're lucky, and really real returns down around 1, 2. So let's call it 2. And then bonds, you're at around 2%, so real returns down around 0. There's no way you can get to 8 to 10% with those two asset classes, no matter how you put them together. The first thing is difficult for buy and hold investors, expectations. But if you look at the valuations for U.S. stocks across any measure, I posted this on the blog the other day, where the median stock in the U.S. is hitting all-time highs on valuation, at least since the 50s, for price to earnings, price to cash flow, price to book. And that's different than, say, late 90s, which was much more of a market cap bubble. It was fixated in the large cap stocks. So you're expensive, but you're expensive in the big stuff. Now, a lot of small caps and mid caps, the whole market has gotten expensive, right? So it is not a good opportunity set. And if you look at foreign, it's much cheaper, but of course there's real no floor to valuation. I mean, it's as cheap as it's been since 2009, 2003, and the early 80s, but that doesn't mean it can't get cheaper. If some of the foreign stock valuations are around 15, which is great, but certainly it can go down. So if this looks very much like a deflationary type of environment, and it's really hard for investors to accept this, but some of the best things that perform in a deflation environment are sovereign bonds, which have had an incredible year last year. And I think U.S. 30-year and zeros were up 30 or 40% or something just incredible. Most people don't think that's possible when bond yields are this low, but it is. So it looks, a lot of our trend following portfolios are either focused only in the U.S. or have moved heavily to cash. I'm very bullish on foreign markets over long periods for valuation reasons. We have a fund that invests in the cheapest markets in the world, but that's been a horrible place to be for the past 6 to 8 months. But the good news is a lot of them have gotten cheaper. So it's interesting times we live in, that's for sure. These commodity markets, what a banner year for the trend followers in 2014 after a lot of quiet years the last 3 years, a lot of challenging markets, and it looks like they're off to a great 2015 as well.
Yeah, that death thing was a little premature.
All-time highs in a lot of the indexes that track the managed futures allocations. I'm still hoping and cheering for a little more innovation there in the ETF space. Most of the offerings are subpar in the ETF managed futures world. You can allocate to them through private funds and mutual funds, but hopefully you'll see a little more innovation there and people can allocate.
Hey, speaking of ETFs, you've got something new that you are have put together. It's out. Tell me, explain. What have you done?
So we've launched 5 ETFs, and my requirements when launching ETF, first, it has to be something I want to put my own money into. And I have 100% of my net worth, investable net worth, invested in my own funds. And it has to be something that doesn't already exist. So there's no way we'll ever launch a Vanguard, style S&P 500 fund, because they do it and they do it better, frankly. But there's a lot of approaches out there that either no one does or that we think we can do a lot better. And so we've launched everything from a shareholder yield fund, a global value, to a global momentum, which is a trend following fund. And the most recent we just launched last month is simply the global portfolio. And the ticker for that's GAA. And it's meant to be just, if you want to buy the world as the world market cap looks today, this is the one fund you can do it with. And I've kind of long railed against people doing buy and hold portfolios and charging a lot. And I'll define charging too much as anything over 0.5%. Because by definition, buy and hold, you're not doing anything. But the vast majority of our industry is taking fees, and pretty high fees, for not doing a lot. So I said, you know what? We're going to put our money where our mouth is, and we're going to launch one. So it owns 29 underlying ETFs around the world. Pass-through owns well over 20,000 securities around the world. It's roughly 40% stocks, 40% various types of bonds, and 20% real assets, commodities, tips, etc. Then it mimics the global portfolio. And then on top of that, we've layered in tilts. So it has tilts towards momentum and trend. It has tilts towards value. But in general, it's a do-nothing portfolio.
Is this buy and hold? There's no strategy.
It is a buy and hold. Now, the underlying ETFs, some of them have strategies. So there's momentum ETFs, there's value ETFs. You basically want to break the market cap link. That's the biggest, simplest thing a buy and hold investor can do, that can add 1% or 2% a year. And it doesn't even matter what your method is. It's anything other than market cap. But the biggest difference is the first ETF ever with a permanent 0% management fee. So we're not charging anything on this ETF. And
how do you get rich?
Well, so our company's profitable. You don't have to worry about us. We're lean. But of the 29 funds, a handful, I think 3 right now are Cambria funds. So we'll break even on this fund when it gets big enough. Maybe let's call it 100 million. But I'm directly subsidizing this fund because I said, look, this entire industry is charging way too much for this. And if I never make money on this fund, I'm happy, because it actually is a wonderful offering I can give to my friends and family. I can't tell you how many times somebody says, Meb, just give me something to invest in. I don't know what I'm doing. I just want to buy and hold. I want to put my 401k in something that I can just, have, and it reflects a global portfolio. And I say, look, there's nothing really out there that I believe in, because either they do it wrong, so they have home country bias, or it's just market cap weighted, or they charge way too much. So look, if this fund gets huge, $1 billion or $5 billion, we'll make a little bit. It'll never be the biggest money maker for us, but it was an important offering that I think I would be surprised if it's not our biggest fund a year from now. But I felt bad continually railing on the buy and hold space without having any sort of solution. So we're glad to finally have it out, and I'm a shareholder as well.
I got a couple other questions here, but one little fun thing that I noticed that you had posted on your blog, and I kind of chuckled to myself because I felt after all these years, was this hiding in plain sight, the fuel gauge thing, knowing on what side to put the pump? And I saw that on your blog, and I was like, God, I saw that in the last year myself. And I was like, did I miss it? Was it there the whole time?
I'm the type of person that I maximize remembering some things, and there's other things that I will just never, ever, ever remember. And I own a car, and I do not know what side the fuel tank is on. And every time I go to the gas station up till this past year, I would get out, look, and then have to it just goes to say something about the way things I remember. But someone told this to me, and I'm trying to remember where I remembered it. But on newer cars, and I don't know if it's the past 5 years, past 10, or past 15, if you look at your fuel gauge, there's actually an arrow that points to the side on which the pump is on which you fill up. And so, I rent a lot of cars, and I mean, although I Uber probably more than anything now, but it has probably saved me dozens of hours of wasted time driving around gas stations across the country.
Hey, let me go back into a big picture issue before I get to one kind of last market idea. Deflation. Why don't you talk about deflation? Because a lot of market pros really say, I don't like inflation. I can deal with it. I don't like it. And of course, the runaway hyperinflation, if that happens in your particular economy, that's awful. But many, many market pros, when they start to talk about deflation, people just start to get really antsy, really nervous. Deflation is the real ugly step uncle, so to speak, in the closet that no one wants to let out because he's always drunk and doing something weird with the kids or something like that. But talk about deflation.
Deflation is challenging because policymakers, they see the two extremes. They see runaway inflation and outright deflation as things that are really hard to control. And Japan has been kind of a great case study in a deflationary type of environment. Much like the U.S. coming out of the late 90s, Japan had an equity bubble, right? Now, it was double anything we ever had here. It was the biggest bubble we've ever seen, but it's had this deflationary environment since. And they've made mistakes. They've tried new things, but the rest of the world, you have this playbook for how Japan has done it. And Japan finally, 2 years ago was the best performing stock market in the world because they've started to do a number of things that potentially will try to get them out of this 2-decade-long kind of sideways type of morass. And so, but it's challenging for countries, sovereigns around the world that have a lot of debt. An inflationary environment's good for a lot of those countries and environments because you can inflate away some of the debt, and deflation is the opposite. And it's also challenging for a world of low interest rates for investors because they don't want to allocate much to bonds. But the irony is bonds are the best performing asset class usually in a deflationary environment, which is hard to get your hands around, but that's the case. And so it's a scary thought, but if you look at the way the world exists right now in most of the developed world, there's not much inflation. Now on the periphery and in emerging markets, there still is, but it's a challenging environment for portfolios. We've seen it in the U.S. for various periods earlier in the century, but it's not something that most people have been as familiar with, in certainly my investing lifetime here. But there are places around the world that have seen it, particularly Japan.
So I want to end with, I caught a quote on your site, and I think you were quoting either a friend or an associate of yours, and the quote was, "Investing is the only place where when things go on sale, people run out of the store," end quote. And of course, even me, I hear that. It's like, well, God, that's just so wise. That's so prescient. It just makes so much sense. Everyone gets that. Hey, when things are on sale, we should be buying, but people run out of the store. But, I started to think, well, what about if there weren't Fed actions and accounting changes in March of 2009? What if, that was the great sale, so to speak, but how do you know that there's going to be the backstop of somebody to stand there and do some things at a central bank or change some accounting standards to where you do get what looked like the death spiral going down, then all of a sudden a reversal? So I was just kind of, you see where I'm going with that.
Well, so here, it's difficult for a lot of people when they think about markets because they often have a certain philosophy, and it's like talking about religion, whether, you're a deep value investor, which is sort of what that quote refers to. It's a value investing mindset, which is very different from a pure trend following type of mindset that is much more, hey, I want to be out of things that are going down. You have no idea how far they can go down. But one of the beauties, and it's even more rare to find someone that can kind of have both of those things exist in their head and not go completely insane. And so a value investor, in my mind, where you have this fundamental anchor, right, where you can, for companies around the world, come up with a broad estimate of what they're worth. And valuation is difficult because it plays out over long time horizons and it doesn't always work, like any investing approach. But thinking about it in that terms. So irrespective of what central banks are doing or governments are doing or tax environments, those, you're always going to have governments meddling with markets. That's the one constant, right? But having a fundamental anchor that at least you can step back and say, okay, this security looks reasonable. And it's more challenging, of course, with commodities or other types of investments that don't slough off cash flows. Bonds are really easy. It's just their yield for most part for sovereigns. But saying, look, this equity is a reasonable valuation. But the challenge is the stuff that's always cheap. The stuff that's cheap is almost always incredibly hard to invest in because no one wants to invest in it for the most part, right? If you look at the countries around the world are cheap, consistently, that's emotionally the most difficult place to invest. No one's going to get off this call and said, man, I listened to Meb, bright guy. Let's go tell our clients to buy Russia and Brazil and, emerging Europe because they'll probably get fired, right? Like it's not something that is emotionally easy to stomach, especially when they're continuing to go down. But it's for the value type of mindset, it's a great thing for the markets to go down because you're getting those investments at a cheaper value. But it's certainly a challenge to be able to do that consistently and not go insane.
Where am I catching you today? Where are you?
Just got back from Los Angeles, was in Houston giving a speech. I'm here for a little bit. Heading
here
to
is Newport Beach?
Is Manhattan Beach.
Manhattan
so north
Beach.
Of there.
That's where we met when we caught up, yeah.
Yeah, over sushi. I'm at the office, which is in El Segundo, closer to the airport. But yeah, great little spot. Where are you?
I'm in Saigon.
Oh, I thought you were back in the States for some reason. Or is that just the holidays?
I popped in and I popped out.
Okay.
You were over in this corner of the world a while back, weren't you?
I was in time. I took Mom. So it was about time to have a mother-son trip, and we went it was a bucket list trip for her. She's always wanted to go to Bhutan and picked the possibly worst, most difficult, most busy part of the year for me. But I said, you know what, Mom, you're important. So we went over there. I think it was in late September. Incredible trip. Beautiful scenery, warm, amazing people. Had an awesome time. Took me about a week to get over the jet lag, but really, really loved it.
Yeah, I'm finding that's really, no matter what I do, if you're going to go to the other side of the planet, it's a week jet lag on either side. I used to think I could navigate it in shorter time frames. Maybe that was just adrenaline, but now it's a week.
There's nothing you can, or at least nothing I can do. But it was wonderful. I haven't traveled a lot in your neck of the woods, so that is certainly on the to-do list to spend a little more time in Asia. So
Bhutan, I've not been to Bhutan, and you thoroughly enjoyed it, I expect.
Well, it's famous for being very isolated. It only opened up to the rest of the world a few decades ago. They limit the number of tourists. It's a Buddhist country, and they're famous for, the royalty I used to always talk about, gross national happiness, right? It was a really, I couldn't say enough, super warm, loving people. The biggest surprise for me was the food was actually fantastic and a lot of spice, a lot of chilies, which is right up my alley. So I brought back a bunch of plants that I've been growing, but it was great. Highly recommended. A lot of trekking. Was
that the only country you stopped in, or you came specifically for that?
No, well, yeah, it was specifically for that. We stopped in Thailand just to try to break up the flights because there were so many. So we spent a day or two in Bangkok, we were in Bhutan for probably at least 10 days. So that's why I was catching up on a lot of your podcasts, driving around, hiking around Bhutan. So
it's a nonstop from Bangkok, though, right?
It is, but there was a brief stop. The plane touched down somewhere in India to pick people up, and that's the only country that they can travel without any restrictions on having guides or fees or whatnot. But yeah, it was straight shot, but quick touchdown.
Well, cool stuff. I appreciate the insights. I want to go there this year, and I want to, if I can get past these restrictions of limited visitors, but I want to get over to Myanmar as well. Mark Mobius was talking about that the other day, and I was just getting so inspired. another one of those places that was taken off the grid, so to speak, by a military junta for about 5 decades. So
I feel like I listened to that, and I feel like Jim Rogers used to talk about that country a lot as well. Yeah, I need to get over that. Maybe a 2015 resolution to check out some of those countries.
Well, I'm trying to influence and get people over here. I've not done a very good job so far. I guess people just assume, well, Covel's lost his mind. He's up the river with Brando, and who knows what's going on. Well, that's exactly right.
Yeah, no, I have some friends that just got back from Vietnam and spoke wonders about it. So,
hey, where can we send people, Meb?
My blog has over 1,500 posts. That's mebfaber.com. My company's website, Cambria Funds, and then we have a research website called The Idea Farm. Any of those, you can find more info.
Amazon, the Ivy Portfolio, and a new book is coming.
Number 4 is coming. It was supposed to be out last month. Let's call it 2 more weeks, and it'll be ready.
Thank you, sir. Hopefully we can do it again sometime this year.
Absolutely.
Take care, sir.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.